We'll now get ready to announce our next group of panelists. We're going to be talking about where climate meets capital asset manager priorities. Please join me in welcoming to the stage Vic Vinayak and the other panelists who will be introduced very shortly. Please put your hands together.
Please come on up. Yeah, so shall we start? It's always a tough act when around this time people want coffee, people want popcorn, and I think I saw some stuff in the back. So please help yourself, but make your way back for a very interesting and exciting panel. So brief introduction on me, Vikrant Vinayak, I go by Vic. I've been involved with this forum since last year. I used to head sustainability for Accenture in North America. And since leaving them last year, I've been on a couple of boards and actively involved in sustainability and climate action related companies. So today on my panel, I have three distinguished colleagues, and I will like to start with having them briefly introduce and talk about what you do and the organization that you are representing. What does that organization do? Maybe we start there.
Thank you. It's delightful to be with you again. This is a wonderful forum, and I've heard so much in the previous panel, so we'll try not to repeat. I'm Kirsten Spalding. I'm director of the Investor Network for a nonprofit called Ceres. My network is about 200 institutional investors. They range from big pension funds and big asset managers to socially responsible asset managers, values-oriented asset owners like religious pension funds, endowments, university endowments. So I work with those investors really in three big ways. First, I support them as they try and integrate climate, human rights, water, biodiversity into their investment decision-making. So they're thinking about how to make good investment decisions with those really core issues in mind, sustainability issues. In the second area of my work, I support investors around their engagements with the companies that they hold in their portfolios. So they engage with companies by having dialogues with them, by writing letters to them, by filing shareholder proposals and then voting on them, sometimes by engaging with directors and voting on directors of those boards. So that corporate engagement area is a place where investors are working on a whole range of sustainability issues. And then in the third area of work, investors come together to try and set the right policy and regulatory frameworks so that they can do their jobs better. So investors have government affairs departments, and we support those government affairs departments as they meet with people on the Hill, federal legislation, as they file their comment letters with CARB, as we just heard. So we offer them support there. We bring them together to learn from one another and to do that policy work in ways that really support the investment and support the changing of capital markets. I'll just say one more thing about what we're currently working on. There's been some discussion about ESG backlash, and I am the network partner that supports things like the Net Zero Asset Managers Initiative, Climate Action 100+, and it's these big initiatives that have come under direct attack. So I'm talking to my members all the time about what they're getting in terms of attacks from regulators, attorneys general around the country, the House Judiciary Committee, We got more letters last week, so I get the letters myself, and I support the investors as they face these attacks.
That's great. We'll have some very good and inciting questions for you. Nuintara?
Yeah, well, thank you so much for the opportunity to be here. I've really enjoyed the day so far. And as you mentioned, lots of wonderful panels. I think there's also some really interesting through lines that have been talked about that we can carry through. So I'm Executive Director of Programs at California Forward, which you heard Kate Gordon, our CEO, earlier today at lunch. But California Forward is a nonprofit that works here in California, really recognizing that everything that we do around our economy in California needs to be from a regions up approach, recognizing there is no one size fits all. We have diverse regions, diverse regional economies, ecosystems, cultures across this state, and that anything we're doing on our around regional economic development and opportunity really has to come from a regions up, bottom up approach. We also recognize that anything we're doing around our economy has to incorporate climate, both the energy transition and emissions reductions, but also importantly, physical risk and the impacts that every one of our communities is experiencing across the state already, and we will continue to experience. So we are really working to drive systems and structural change at the state level that better couples our economy and our climate agenda, which is, I think, something we will talk about here on this panel a bit. And just really quickly, I think there's been a lot of conversation here around the emissions reduction side of things. One of the things that I'm excited to talk about on this panel too is, and we heard a bit about this too, is the resilience and adaptation side and where and how that shows up for capital investment and for asset owners and investors, and really the urgency of figuring out how we better operationalize climate risk into our investment decisions, because we will not achieve any of our emissions reduction goals if we're not also incorporating physical climate risk into those investments and beyond. And last thing I'll just say is one of the things one of the hats I'll put on here is just my experience working at state level, really thinking about public agencies and the public as asset owners and investors as well as an important partner in all of these conversations.
Thank you. Over to you, Ilmi.
Hi, I'm Ilmi Granoff. I wear several hats, but I'll name two here. First, part of the week, I am an adjunct research scholar and senior fellow at Columbia Law School's Sabin Center for Climate Change Law, where I've helped stand up a sort of initiative and center of excellence between the Sabin Center and the Columbia Center for Sustainable Investing on climate law and finance. So we have a lot of ongoing research and analysis and work in that space between the two centers that we work on. Most of the week, I run a consultancy, an advisory, a strategic advisory focused on decarbonization. We like to think of ourselves as a consultancy with a view about how decarbonization happens and how that relates to the capital markets. The fundamental notion that we have is really that the key unit of decarbonization is capital stock and capital stock transformation. It's capital assets, and that by focusing on capital assets and not emissions, we actually have a easier way of understanding how different stakeholders influence decarbonization and how investment and finance relates to decarbonization. So we advise nonprofits and philanthropies, companies, and financial services firms on strategy around climate in light of that sort of view. Those are my two main hats. I'm also on the board of Carbon Tracker and a few other things, but all bring that same perspective to work.
That's great. So if we look at in the composition here, we talk about private investments, we talk about public investments. So I think it'll be good for our audience to have two things. One is, what are some of the considerations as investments are made, private or public? And how are some of these, or what are some of the differences as the investments are made? Are there any material differences that the investors are thinking of? So maybe we'll start with you, Ilmi.
Sure. Okay, this is an interesting one. So putting aside asset management per se, we're talking about the different role of public investment and private investment. And one of the things that I would want to highlight is that our view of how climate policy works should have fundamentally shifted in the last couple of years. So I got to speak at the last one of these a year ago, and I sort of said Inflation Reduction Act, Inflation Reduction Act, Inflation Reduction Act. And I still think that that is important now. Why? Two things. One, it's about specifically the Inflation Reduction Act. I want to remind everyone that despite the shift in administration, about $100 billion has already been obligated by the federal government under the Inflation Reduction Act. That is bigger than the Recovery Act under Obama already. If the cornerstone of IRA continues, the tax credits, which it seems like it's pretty resilient for various reasons, mostly because the private sector and capital likes it, not just voters, that will continue to increase. It means it's quite a resilient tool. And so the second reason to point to that is, I think what we've learned, and I really don't want a memory hole because we're kind of in this panicked moment with federal policy shifting, is that investment-led climate policy is an incredibly valuable and resilient tool. It is not to denigrate the value, thank you, not to denigrate the value of sticks, but sticks work best when you're already coming down the cost curve. You have technologies at price and performance parity. You see opportunity in zero carbon substitutes, and it's relatively trivial for a company or a private sector actor to substitute from a high carbon to a low carbon capital asset. And then the sticks work really well because they're like, okay, you're not penalizing me. You're just asking me to substitute a preference that I'm relatively indifferent towards. So I don't want a memory hole that on the public sector side, public investment in decarbonization, I want to disagree with my friend Paul Bodnar, who had the keynote earlier, is strategic. It's not just tactical. It's extremely valuable to commercialize new technologies, bring them into the market, help them commercialize and compete. On the private sector side, I'll just say I really think, and sorry, for private investment, and we're talking about businesses in the business of investing, not corporate investment, I'll say I really think we should take this moment to recalibrate a little. Their job is to seek risk and opportunity in the market, and they should get out of the way when they see those opportunities and look for opportunities in the low-carbon economy. And that is really, that's how capital markets function, and we want that to work that way. There should be a little less hemming and hawing about the function of investors and real focus on seeking those opportunities and allocating risk and opportunity, risk and return, allocating capital to seek risk-adjusted return, which is what they know how to do best. And I think there is a lot of opportunity in the low-carbon transition, regardless of what federal policy looks like. And will continue, especially if you're a global investor and exposed to all the world's economies, or many of the world's economies where decarbonization will happen apace, and even in the U.S. where that will continue to happen because of the techno-economics.
Thank you.
Maybe I'll just start by sharing something that somebody said to me a couple months ago, and I'm now going to use it all the time, and I think it fits with your reference of carrots, which is someone said to me, they're not going to worry about carrots and sticks anymore. They're just going to worry about hitting people with carrots. So I think maybe that you can take that one for now in that context, which I really appreciated, which also if you put into ChatGPT or whatever your AI of choice is, to design an image of a bureaucrat hitting people with carrots, you get some amusing graphics as well. So I'll leave you with that. I think two things building on what you were saying. I think one of the key differences from a public sector view is around kind of managing and thinking about public good. And then the second is around kind of the governance of how decisions are made in the public sector that are different, and they need to be aligned with the private sector, but I think they are unique and in worth calling out. So first on public good, And it's, there's public good as kind of the steward and of the entity as the government plays to manage and support communities. It's also steward of the public good because at the end of the day, public agencies and government is ultimately responsible and cannot leave a place. Private entities, individuals, to some extent, can leave places and they can move. Government cannot, which means they are holding that risk. And one of the things that we are really focused on as we're thinking about where and how to align public and private investment is recognizing that at the end of the day, to reduce physical risk and the risk of climate impacts, we have to be making strategic investments to reduce risk so that those risks aren't continuing to fall on public balance sheets. And I think there's also a really strategic role for public investment as we're thinking about incorporating climate and the true cost of climate into our pricing, which means sometimes costs will go up in certain locations. Sometimes there may be economic disruptions where the public needs to step in, but there's a really important role for public subsidy so that as we're making that transition and we're incorporating the cost of climate into our decision, we're not leaving communities behind who already are cut off from access to capital or may be cut off as pricing is actually reflecting true climate risk. So I think that's a really important role that the public sector plays, is actually helping and guiding the transition by making strategic public investment so that communities aren't cut off to access the capital. And then the last piece I'll just mention around kind of the governance and decision making. I think we all recognize government decision making is messy and complicated, and often the decision isn't held by one board or one actor. It is spread across many different actors who have a role. For example, in California, of the 8 constitutionally elected state offices, 6, in my view, maybe they all do, 6 at least play some role in helping to think about how we manage climate risk and our transition. And so that decision-making across those constitutional offices make it very complicated. It also calls to the importance of having strategic coordination and alignment across and within government.
Thank you.
Thanks. When I talk to the investors in my network, they really talk about their primary job, getting risk-adjusted returns for their clients or beneficiaries. That's their primary job. But they look to the public sector for the leading trend. In some cases, I think they feel like the public sector can help reduce the risk, or they can signal the demand. And so just picking up on what Ilmi suggested around the IRA, what investors did when they started to see dollars flowing in this dramatic industrial policy into the economy of the future, investors said, there's good opportunity for me. So just as examples, we're seeing many more clean energy jobs being created today in Texas than fossil fuel jobs. The new jobs are there. Because those are new clean energy sources, there are now all kinds of ancillary investment opportunities for asset managers. So the private sector follows the public dollars. But as I said in my introduction, I think there's another role for the asset managers. Not only do the dollars follow where the public dollars go, but they also have a role in advocating for the policies that'll keep the dollars going in the right direction. So one of my colleagues, Ben Tabor, is here. Last week, 80 meetings on the Hill with Republican offices, investors and companies, meeting with those Republicans to help them really understand why those tax incentives matter, why they're creating good private flows of capital following the public dollars. We talk about it as leverage. Every public dollar needs to be leveraged by private dollars. But from the investor's perspective, this is just doing what they're supposed to do, get good returns. So you want to see those tax incentives because they improve the bottom line. They improve the return for their clients and beneficiaries. So there's a lot of synergy here.
Go ahead.
I just want to build on this and just pile on because it's a good thread. There's a lot of consternation about departures from net zero alliances, and I think there's good reason to be worried about that. But I think the real test of whether the financial sector is grappling with the transition at some meaningful level or not is whether it protects the opportunity that it has been created for it under the prior administration. Is like its ability to defend IRA. If you want to like test resolve, we kind of look for these signals. We go, oh, they left this alliance. It's so bad, and we said, like, it's not great. It's not a good signal. But the real test is whether they've been given these opportunities and whether they defend them. The Global Financial Alliance for Net Zero, Glasgow Financial Alliance for Net Zero, has this framework of transition finance, the different tools financial institutions can use to engage on net zero. Climate solutions investing, working with aligned companies, working with aligning companies, and unwinding high carbon assets. Sounds like a nice menu, but I think what we want to move away from is realizing that some of these are much easier and more aligned with how businesses work and how investment works than others. Investing in climate solutions is aligning the interests of the company who's generating revenue from a climate solution with the interest of the investor or the financier who is getting paid dividends or debt service from that climate solution. All the incentives are aligned. So it's much easier to do that. If you're trying to work with an aligning company, to take another one, jump ahead, you're still generating revenue from high carbon stuff while you're trying to talk it out through management because you own some shares from the secondary market to influence its direction of travel. Not to say it's bad, it's much harder. And unwinding high carbon assets, great stuff. We call that a workout in the private sector. It's really hard. You're taking a haircut. So it's not equal. And so what I wanted to point to is where interests are aligned with financial institutions is on climate solutions and investing in climate solutions. So if they get it, they'll defend the ability to find opportunity there. And that's where we should keep an eye on them and keep up the good work.
Can I add one more addition, which is, I think, on the to that last point you made, I think where there's additional work to be made to help with that kind of the aligned space is on understanding the benefits of investment in risk reduction and resilience. I don't think we are quite there on that side as maybe on the emissions reduction and the transition side, because we aren't seeing sustained investment in resilience, in risk reduction, actually being carried through other economic incentives consistently. It still is a patchwork, and I think some of the insurance market instability that we see in California, in other states, is a product of misalignment across the investments that are being made. They are not enough. We need to invest in more, but they're not being carried through enough, and we need to make strategic investment to better align on that side.
Yeah. There's so much we could say about that, but just to pick one specific example, sustainable ag. So investors are now more and more talking about the need to invest in sustainable agricultural principles because drought means they're not going to be able to continue farming as they used to. So for anybody who has an ag sector part of their portfolio, the investors are really thinking about resilience, adaptation, and they're not talking about them as policy matters. They're talking them about investment risk and the opportunity to be ahead. So the company that adopts change now is going to be better positioned for the economy that's coming.
We should let you ask another question.
No, this is great. And so switching gears a little bit, we talked earlier in some of the sessions about disclosures as well. So what do you see these asset managers or investors, what is their consideration for some of the disclosures? That's number one. And the part two of the question is, you see much difference in private versus public, or are you seeing something similar? So maybe we'll start with you, Christian.
So the last panel was terrific, and the investors I'm talking to did recognize that there was likely to be change in the CSRD, CSDDD. They're waiting for the California regulations to come out of CARB. They're engaging in that process. But I think they're putting a lot of emphasis on ISSB and really recognizing that the TCFD standard, the Task Force for Climate-Related Financial Disclosures, did give them investable data. It was really important. It became a baseline for corporate disclosures around climate. It identified the risks. What I'm seeing investors now ask for is get ISSB adopted in more jurisdictions. More comparable data would be great. But in the meantime, if you do have good TCFD information, what's the risk? Now move towards show us the plan. And there was some discussion about that as well earlier today. What kind of information in the plan will be useful to investors? It's not just a vague, here's what I'm thinking about, but really, what's the business strategy? This is about core governance issues. Investors want to know that this is a well-managed company with a plan to align its business strategy, its capital expenditures, and its accountability mechanisms, its accounting and its disclosures to ensure that they're going to be really a high-value company in the future. So I'm hearing emphasis on ISSB and getting that adopted, and then looking for going from TCFD to transition plans.
And yeah.
Yeah, maybe from a different, or from that kind of a public sector kind of experience, having worked a lot a couple years ago, think about how TCFD, how would you apply a TCFD structure or framework for a public entity and in a state context? And I think in addition to everything you have mentioned and some of the same issues that were brought up in this last panel, I think two things from a public sector perspective. One is that public entities are also part of this disclosure reporting structure because public entities are clients of some of the required corporate and private sector reporting entities. And I think making that case that part of this is also understanding and helping to provide insight into where and how public investments are made in that kind of economic value chain is helpful to understand that it's kind of in our real economy, those investments are, all interconnected. So I think that's one point. The other is around from a public perspective, and we see this in California, depending on we'll see as the CARB process goes through. But one of the things that I think is a real opportunity from a public sector lens is disclosure is a useful tool, but it's not the end all. And one of the things I'm really interested to see come through, we'll see what happens in California, is how does the state use the information that comes through disclosures to help the state manage and better understand broader economic risks that they also need to be managing. And so really thinking about what's useful both for the entities who have to report, for them and their bottom line and understanding their own risk, but then how do you also translate that through to help public entities manage the broader kind of economic risk that they need to be thinking about?
Well, it was agreed that the prior panel was great, and Sue's as a honorary member of the prior panel, I really appreciate you pointing out that we had kind of weird expectations of what would happen in Europe, and I think it's because the European regulatory process is often quite aspirational in its design, and we've seen that with other regulatory regimes. I'm a former Freshfields lawyer. From many years ago, and so I have a bit of experience across both sides of the pond, and there's sort of like a category error in understanding how policy is approached in Europe. But, set really high aspirations and kind of work your way back. And so no surprise that the capital markets are still regulated to allow private actors to allocate financial capital to seek risk-adjusted returns, not to have it prescribed to them. So the idea that financial institutions would have to have transition plans that met a particular public target, that is the government saying you have to allocate your financial capital as we prescribe. It's not really a market at that point, and there's probably better ways to get them to do that anyway, like IRA. So no surprise that we backed off there. I want to focus. So I think disclosure is great. It will help us make the market more efficient, not get out of capital efficiency, which means to the extent that the transition is happening, which I believe it is, we'll be better able to price it in. Some people don't think it is happening, and I think they'll misprice the transition. But that's the best that disclosure can do. But I do think that I'll point to one particular area of disclosure that is a hot topic, because I think we have a little bit of footprint and target setting fever. Footprinting is useful, but it is not it's not even a particularly good indicator of transition risk. It is a contributor to that if you break it down and look at different parts of the footprint differently, because different parts of the footprint represent different risks. But the idea of a transition plan is quite useful. If the markets will continue to exist, we eventually have to get to net zero. I don't know what the inferred temperature of that pathway it is, but we will get to carbon balance or the wheels come off the bus. So the world will fundamentally decarbonize at one point or another, and even later or earlier has profound impacts on a business's capital decisions now. So I want to get out of the mode in disclosure world of treating a bundle of targets as a transition plan. Target setting is not a plan. It's not a strategy. It's a set of aspirations. And I would point to one metric that I think is particularly useful as we move into what investors should want to know about companies in their portfolio to understand how resilient they are to the transition, how much they're anticipating, et cetera, which is capital investment. I think if there's really a valuable debate to have between owners of the company, the shareholders, and management about what information they need to understand where the company is going, it is more detail on the capital plans of the company, down to individual assets. And there's a real debate to be had there in terms of what part is disclosable and not. But if there's any place that's actually crunchy and real, it's there, because I can tell you for any company that has an emissions-intensive business, I can tell you I don't need their 2030 target or 2035 target if I have their capital plan. They're building those assets with assumptions about the utilization rate of a power plant or the amount of vehicles that the manufacturing facility will produce. And implicit in that is the emissions of that company. You don't need their target. You can see it in the capital plan. So that, I think, is really where the rubber hits the road in terms of disclosure being meaningful. And by the way, when you're doing primary investment, you're providing capital to the company to build those capital assets. So the link between your investment and the emissions is very clear. It is, your purchase of that bond is giving the company money to build that capital asset.
No, very well said. So switching we talked about a little bit of a political and economic uncertainty that we are living through. So first thing that comes to mind is what is the flow of capital looking like now based on this environment? Are people pausing? Are people doubling down? Are they, still investing but with caution? Then the other thing that just very interconnected is that what are some of the things they're thinking through, and what areas are they investing if they're still investing? So would love for you to share with our audience just that, that whole evolution of that question.
It's a really good question, and it's the good news from my perspective. So, I run all kinds of working groups for investors. They come to listen to one another. And in light of the backlash, some of the things are no longer popular topics, let's just say. But I had a webinar a couple weeks ago on climate solutions investing, and 140 investors showed up. So there's no question that there's movement, there's interest. In that particular webinar, we had two macro analysts really talking about where they saw the economy going, where there were opportunities. And it's nuanced. I think we have to be careful not just to say every investor should invest in a climate thematic. If you say that quickly, it sounds like a good news story because there will be opportunities as a result of climate change, but you've got to be really specific. So I'm hearing a lot about demand. the investors are saying because of AI and big data centers, those big tech companies have made commitments to try and source green energy, clean energy, renewables. And as a result, there's investment opportunity there. Look to the places where those data centers are growing fast. Look at whether the grid is enabled to take on those new power sources. There's lots of investment opportunities. The other big one is, as we've just started, IRA investments. So infrastructure, huge. All of the dedicated infrastructure investors are making money. They're really excited right now, and they see that continuing. Even in the resilience realm, what are we doing to build our highways differently, build our ports differently, really think about all of the places that are impacted by now what are fire seasons, tornado seasons. How do we build in those places in such a way that they will be more resilient and will adapt to new climate? So I think the investors are, whatever their particular investment strategy is, they're looking for those opportunities. And I would say it's not slowing down. The appetite is still there because it's a place where money can be made.
Yeah, on the climate risk and resilience side, I think, there definitely is the chilling effect that we are seeing across the board in different areas. But I think fundamentally, where I want to stay optimistic, like you're going to stay optimistic, is that investors, whether public or private, are still asking themselves a set of really important questions, which really bring physical risk into kind of financial models and performance. The first is, will there be impacts to revenue? You were talking about, sustainable agriculture. I think that question is being asked more and more on public and private, right? I think public agencies are trying to understand what are the impact to local revenues, whether it's property tax, sales tax, other taxes that are driven by climate impacts, and trying to get a better handle on that. So I think people are still asking themselves that question. They're also, looking at what are the capital expenditures that need to be made to protect against future climate risks, to maintain whether it's performance of an asset or, or social services within a community. Those questions are still being asked. This question of insurability and affordability is absolutely top of mind, and I think that, till we figure that out, will stay top of mind. The cost of capital. I mean, we saw rating agencies very sadly and unfortunately downgrade public entities and utilities following the LA wildfire. I don't see that changing in terms of thinking about the cost of capital and the impacts that climate is having, both on the risk side, but then hopefully we get to a place where capital is also rewarding investment, again, in sustained resilience and that risk reduction. And then finally, this question of asset valuation and what is the life of an asset. And just one quick thing here to add on to this point. I think there's been a lot of conversation around in the climate risk resilience space, okay, if there are risks, do you not invest in a place? And there's whole conversations around planned retreat or however, we need a new name for that. But, thinking about this life of assets, I think it's really important when we're having those conversations, we think about time scale because risks exist everywhere. And really, I think the better question is how much risk can we tolerate in a place and evaluate that relative to the benefit of that investment. So, for example, I was talking to an economic development director for a coastal community in California, and he said, I can on the back of this envelope pencil out for you why I should make an investment in a wastewater treatment plant that's on the coast, even though the anticipated life is not going to be as long as it would be if we didn't have sea level rise. But what it does is it sustains my economic base to buy me time to make a plan to figure out how to make strategic investments in infrastructure somewhere else. So I, as my community, we can have a revenue base to maintain. So I think there's some additional insight that we need to be thinking about when we're thinking about kind of asset valuation and the life of assets.
I've forgotten the question. I think you wanted to know about the sort of political moment.
No,
And,
so
yeah, okay,
let me repeat it.
Yeah,
So essentially, right now, there's a lot of political and economic uncertainty. I mean, those of you who haven't looked at the market, it went down again today, a little bit of a reminder of that uncertainty. So in that uncertain environment, as you engage with in your consulting role and your other roles, are you seeing people still continue to invest? And if yes, what considerations are making them invest? And if yes, what are some of the areas they're investing in?
Anyone who thought the transition to net zero economy could be orderly was gravely confused. And I just want to point to the moment that we're in. Elon Musk became the world's richest man by selling electric vehicles with the support of the federal government and carbon credits. Became the world's richest man and bought his way into the co-presidency, where he's making us a failed state domestically and a rogue state internationally, on the back of being one of the greatest climate solutions entrepreneurs that we've had, mostly with the help of government subsidies, but they were there for the taking, and he took them. That has then precipitated in Canada a radical shift in politics, where one of our greatest climate champions that the world has had, Mark Carney, is in line to be the next PM. This is a very disorderly transition, and so, right. So, but this is we have to update our mental model that disorder is part of the transition. If we expect the transition to have secularly declining oil prices, then we've missed the point that as we move away from oil, as demand is destroyed by batteries, you will have supply constraints because of a mismatch between supply and demand that will drive the price up temporarily, will drive up profitability of oil companies, and it will look like, oh my God, ESG doesn't work anymore. And we're going to go, if decarbonization is happening, that is what it will look like. It's not like, oh, it doesn't happen. But the market is having a little bit of trouble figuring that out. And I don't think the larger political environment is going to help with that for a couple reasons. One is, I don't think we should focus. I did a project for a unnamed nonprofit on how to make sense of the anti-ESG situation, and we did a scenario analysis of where we might be. We were in what we called the muddling through. It was sort of there, it was an annoyance. We're now in the worst scenario. It's called blowback that we anticipated. What is the end game? It is that the federal government and the far right will try to make even profitable investments in clean energy, characterize those as reflecting of values and ideology and not risk and return. It's going to be to merge those two. It's not going to be about ESG fund design and whether you can do it or not. It's going to be, you've invested in a clean energy asset. That's because of your extreme left-wing values. I don't care that you're making money from it. So this is why the center is IRA. We have to protect that those are good investments. But that's going to be hard because you're also going to have the rise of the incumbents. In this moment, they're going to take that cover to say we're here to stay. And let's ignore oil companies because they're too easy to pick on. Why are we talking about this incredible growth in demand? I was talking to a tech company recently, one of the biggest ones, who's generated this conversation and has a big AI product, who said, yeah, we do think that there's going to be increasing demand, but we're not the ones promoting that. And we agreed on that conversation that that's utilities, because cui bono, they're the ones that benefit from projecting increase in demand. So why is CERAWeek this week talking about AI demand? It's because utilities are the incumbents and they want to talk their book. So the hard part about the moment that I want to flag is that we're not going to have this overlay of everyone talking about climate. Everything's going to have a climate label. If it has the climate label, you just go, it's good, and you're going to have to weed through the signals, knowing that when a utility says, well, demand is just going to go through the roof, it's because they're on a cost plus model and that's how they generate revenue. And of course they're going to say that. You've got to read between the lines about how real and not real that is. If you're trying to manage climate risk, you're not going to have the overlay of a really salutary policy environment, et cetera. You're going to have to actually understand the nature of the risk. So it is a very different environment. Luckily, as I think has been reiterated again and again, some of the capabilities to understand transition and resilience related risk and opportunity has been built up over the last several years. And to the extent that that holds, which I really hope that it does, and I think it's pretty resilient, those skills and capabilities will help still allocate capital efficiency as we go through a transition and we face physical impacts.
No, very well said. And the only thing I will add to is, as I'm talking to various private equity investors, it validates everything that you guys have said. There is money out there, but it is for where there is clear value and return on that investment versus 2 years ago, stood in the room and said, I have something on sustainability. People didn't care what that idea was. People were ready to invest. That is going away. So thank you. I think we'll open it up to the audience for some questions.
Question kind of following up on something Ilmi said earlier on kind of assessing how financial institutions are still in climate and that they're pulling out of the voluntary commitments is not something that we should maybe care too much about, but that looking at whether or not they are vocal in protecting parts of the tax credits and parts of the Inflation Reduction Act. And I'm just curious, what are the odds you actually think they're going to do that? I think I'm personally a bit skeptical about financial institutions in the U.S. doing any kind of positive lobbying on climate. And I know that there has also been investor pressure on climate lobbying and advocacy, but yeah.
My wager is public. I wrote a piece for Heatmap News before the election that they didn't publish before the election. And then after the election said, oh, great, now's the time. And it is called the Cynical Optimist's Take on the Inflation Reduction Act. And I'm a cynical optimist. My view is that we can't, first of all, this is about probabilities. I think IRA is extremely resilient. It doesn't mean that it will withstand the temptation that extension of income tax credits present. Because if you're posed between the opportunity to get some corporate tax benefit from tax credits, from the transferable tax credit market, and you juxtapose that as a manager about the ability that you could get an income tax credit, it's a dicey situation. That being said, I think it's far more resilient than if we'd had a carbon penalty that was gradually increasing in place and then faced this political circumstance and tried to figure out how to navigate that. So I think we just saw a letter from 21 Republican legislators saying that they really want to keep the transfers market. I think there's a lot of appetite. And I think that already reflects the fundamental truth that it is a more resilient approach. The reason it's cynical is because I don't think it's really about voters that much. We live in a bit of an oligarchy, and I think capital speaks louder than voters, unfortunately. And so the fact is, the Inflation Reduction Act was built on corporate tax cuts. They're tax credits. They say you get a tax cut if you invest in certain things. and it's kind of a good model. I was pretty skeptical about tax credits as the main industrial policy tool, but now I realize that offering a tax cut and saying you have an alternative, you pay the government to allocate that capital or you allocate the capital and get a tax cut, is actually pretty sophisticated politics, and I've been converted on the value of that and its resilience. But it doesn't mean that it will withstand. My hope right now is that we'll just deficit bust and go wild and keep the credits because it's too hard to get rid of them. And we'll probably end up with that income tax extension as well, and we'll have to deal with that problem second.
Any other questions? Okay, great. Well, thank you for your insights. And Anjali, over to you.